In this segment of the video, I highly recommend that you use the PowerPoint that's marked as the student version because it doesn't have the answers. The reason for this is it would be highly beneficial for you to pause the video as we go through the transactions to try it on your own first, and then play the video to see if you got the correct answer. I've also given you the instructor version so you have all the appropriate notes that are included in the PowerPoint. That doesn't include the things that I write on the screen, but I think using the student PowerPoint and actually taking the notes as you go may be beneficial to you, as that's what you would do in a normal classroom setting. So please keep that in mind. Transaction analysis is exciting for me because this is when we actually get to apply some of the concepts that we learned and do something as opposed to just learning vocab. So with transaction analysis, we're going to use our accounting equation. And it's important to know that every transaction affects at least two accounts. So we're going to have at least two accounts impacted, which should make sense because if the accounting equation has to balance, at least two things have to be involved. So we can have either assets go up and liabilities and equity combined. One of them has to go up or both has to go up. We could have assets go down and then liabilities and equity go down. Or we could have a situation where we're up and down under assets or up and down under liabilities and equity. Because if we go up and down on the same side, that would net to a zero effect. So you either have to go up on asset, up on liability and equity, down in assets, down in liability and equity, or up and down on either side in order to make it balance. Bottom line is there's got to be at least two accounts involved in order to have this up, down, or up, down effect. So the first step is to ask yourself, given a problem, what was received and what was given? So just logically in the problem, it should be easy to determine what the company received and what they gave up. And then based on those items, it should be easy enough to identify the appropriate accounts, which are the titles that we're going to use to record the transaction. Then we have to figure out, are we dealing with assets, liabilities, or equity accounts? Because that's going to help us determine where under the balance sheet equation we put them. And then we figure out the up and the down of the effect. For any of you that taken accounting before in maybe high school, you may have learned about debits and credits, and you may start thinking in terms of debits and credits. At this point, I highly recommend you focus on the English. Okay, I say we basically do what I refer to as caveman or cavewoman speak, which is we're going to say asset up, liability up, or asset down, equity down. So we're just talking in terms of up, down, something you knew before you even started this class. And then I will teach you very simplistically how to convert our English up, down to accounting, debit, and credit. I'm going to give you a conversion guide, and all you got to do is take the English parts, the ups and the downs, and convert it. The hardest part is understanding what accounts are involved and what the up and the down is. The debit and credit conversion is extremely easy if you embrace the methodology that I will teach you. The next step is to verify the accounting equation is in balance. So once we determine the accounts involved, the ups and the downs, we got to ask ourselves, did it work? Does assets still equal liabilities plus equity after we record those transactions? So now we're going to go through a series of transactions and figure out how to best record them. So Chipotle issued 10,000 additional shares of common stock with a par value of a penny and a market value of 37 cents a share. So they received $3,700 from investors. Now you might say, what the hell is par value? Well, if you read the textbook, you'd know, but assuming you haven't and you're watching my video first, the par value is just an arbitrary amount that's assigned to a share of stock. Well, what the heck does that mean? It just means that under equity, we've got contributed capital and retained earnings. Contributed capital is made up of common stock and additional paid-in capital. Common stock is always going to be the number of shares times the par value. Additional paid-in capital would just be the difference to make it balance. All in all, this contributed capital represents the amount received from owners. Back in the day, it used to be that the par value represented the minimum amount the company needed to keep on hand as cash in the business. But now the par value in most states is so small that it really has no meaning. It just affects the way we record it on the financial statements. So the first thing we need to do is figure out what was received and what was given. Well, we received $3,700 and we gave ownership of our business. So cash would have gone up $3,700, and then we got $3,700 in equity. Now, a lot of students, when they do this, might think, well, cash goes up, but I'm giving away equity, so equity goes down, and that would be incorrect. And the reason is common stock and additional paid-in capital, which again is made up of CC, contributed capital. That's what this CC up here stands for, contributed capital, represents the amount that's been invested by owners. So if owners invest more money, they just gave us $3,700, then contributed capital is going to go up. And frankly, there's no other way to make it work. If assets go up, equity's got to go up. You got to go up on both sides to make it balance. To determine the amount that goes into common stock and additional paid-in capital is just sheer memorization. Okay, which you have to remember that common stock is always number of shares times par. So they took the 10,000 shares times a penny to get the common stock amount. And then additional paid-in capital is the difference. Well, what the hell's the difference? Well, 10,000 shares times a penny is $100. $3,700 was the cash we received. 100 is what goes into common stock. So the difference to make it balance is $3,600. So putting it under our accounting equation, assets go up under cash, $3,700, and then contributed capital goes up by $3,700. That's broken up into the components of common stock, which is the number of shares times par, and the additional paid-in capital, which is just the difference between the amount of cash and the amount we put into the common stock account. Again, don't expect it to make perfect sense. It's really stupid, honestly. They should just shove it all into a contributed capital account. But they break it up into common stock and additional paid-in capital because of the concept of par value, which is, again, an arbitrary amount assigned to the shares of stock. It has no real meaning. It just affects the accounts that we use to record the transaction. Bottom line, assets went up and the amount contributed by owners went up, both by $3,700. Once I go through that, then I have to figure out if my equation's in balance, and indeed it is. Assets went up on one side, $3,700, and then equity on the other side went up by $3,700. So A still equals L plus E. B says Chipotle borrowed $2,000 from its local bank, signing a note to be paid in 3 years. You might say, what the hell is a note? Well, we're borrowing money from a bank. A note is a loan. And you may remember from previous slides or even chapter 1 that there was a liability account called note payable. So that's what we're going to use here. So the account names that are involved is we got cash, money coming in, and we owe that money and we call it a note payable or a loan payable. Again, you're not going to have to pull these numbers out of your hat. You're going to be able to figure it out by using multiple choice test items or drop down menus and homework. And just through practice, you'll know, oh, we signed a note. It's a liability. So a good name for it is note payable, because remember, payable comes up with liabilities and a note is just the loan document itself. That's what it's referred to as, a note. So cash go up and our liabilities go up. Why does cash go up? Because I'm getting money. Why do our liabilities go up? Because I owe more money. So you could see transaction B is what we're focusing on here. Our cash goes up and our liabilities go up. And that puts our equation in balance because both assets on one side of the equation and then our liabilities on the other side go up by $2,000. So I received money, but I owe that money back in the future. So both assets and liabilities go up. Let's move on to our next item. C, Chipotle purchased $10,000 in additional land, $8,200 in buildings, $33,800 in equipment, and $3,700 in additional intangible assets. They paid $53,400 in cash and signed a short-term note payable for the remainder, and luckily they did the math for me, $2,300. So what do we get and what do we give up? Well, again, I'd recommend you pause the video and try it on your own first, and then resume. Now that you're back, what did Chipotle get? They got some land, some buildings, some equipment, and some intangible assets. What did they give up? Some cash, and they also have to give up a promise to pay cash in the future, which would be a liability. So we received lands, building, equipment, and intangibles. What do we give up? Cash and that liability. So in our accounting equation, our assets, various assets go up, and our liabilities go up by the $2,300 we still owe. You'll notice that one of our assets, cash, goes down because we've given up some of our assets, cash, for some different assets, property and equipment and intangible assets. You might try to figure out where the amounts come from. Property and equipment, the $52,000 is the sum of land, buildings, and equipment. Our intangibles, obviously the $3,700 lines up, and the cash and the note payable line up. Once we're done, we need to check and make sure we balance, and the net effect of all of our assets is a net effect of $2,300, which corresponds with the positive $2,300 impact on our liabilities. So our balance sheet is still in balance. D, Chipotle paid $2,300 on a short-term note payable in C above, and $2,300 on other non-current liabilities. So basically what happened in D is we paid off some debt. So what did we give up? Well, money. And what did we get? A reduction in the amount we owed. So we received a reduction in the amount we owe. We've given up cash for that. So in our accounting equation, cash will go down $4,600. Again, we're just focused on item D. A, B, and C are the previous transactions that we recorded together. So cash goes down $4,600. Then our note payable goes down $2,300. We're paying off that note payable in C. So note payable went up by $2,300 in C. In letter D, we're paying it down. And then it said we're also paying off another $2,300 in other liabilities that were incurred in the past. It should make sense what's happening here. We're giving up money, so money go down. And when you pay off your debts, logic, think it through. What happens when you pay off your debts? You owe less money. And that's why those liabilities are decreasing. Net effect on assets is we're down $4,600, and then we're also down $4,600 on liabilities. Remember, parentheses means negative in accounting. Moving on to E. Chipotle purchased the stock of other companies as investments, paying $44,000 in cash. Of this, $9,000 was short-term and $35,000 was long-term. So what do we get and what do we give up? We got ourselves some investments. We gave up some cash. So we got some short-term and long-term investments. We gave up some cash. So this is an example of up and down on the same side. Our investments go up by 44, the short and long-term combined, and our cash goes down by 44. Again, we're just focused on the bold item E right now. So our assets go up and down by $44,000. We've just exchanged cash for investments. Is the equation in balance? It sure is. Nothing happened to our assets and nothing happened to our liabilities and equity. So we're still in balance. It's okay if the net effect is 0. You're still in balance. No effect on either side. Let's move on to F. Chipotle doesn't pay dividends, but instead reinvests profits to grow the business. However, we're going to assume that they do pay dividends for our own purposes here. So if they pay $3,000 in cash dividends, how is that going to affect things? Well, what are we receiving? We're receiving lower undistributed earnings. I mean, really, this whole receive and give thing can be a little tricky. What are we doing? We're paying out dividends. When we pay out dividends, our retained earnings goes away because we're keeping less. What are we giving up? In this case, if we haven't paid for it right away, because it says we're going to pay it in the next quarter, we're going to be giving up a promise to pay in the future dividend payable. We'll give up the cash later on when we actually pay it. So don't get too caught up on received and give. Let's just talk logically again. What happened? We decided to give out dividends. Dividends are the return of earnings to the owners. You may remember our retained earnings formula. Our retained earnings formula is beginning retained earnings plus net income minus dividends equals ending retained earnings. So whenever we pay out dividends, it reduces our retained earnings. Then it would either reduce our cash if we paid it, but because we didn't pay it right away, our dividend payable liability goes up instead. So again, focusing on the bold, our equity go down and our liability go up. So this is another example of up-down on the same side. This time we're on the liabilities and equity side. Are we in balance? Sure, there's no net effect for this transaction. So assets went up 0 and liabilities went up 3 and equity went down 3. So the net effect is 0 again. And the overall effect on A to F still is in balance because the net effect of A through F all added together is a positive 3,400 on our asset side and a positive 3,400 on our liabilities and equity side. So the bottom line is each transaction needs to balance, and then if that is true, the total of all those transactions would still balance. Now you might notice that we didn't talk about selling anything yet. We're not selling any burritos. So the reason for that is our focus in this chapter is on the balance sheet. Once we start selling burritos and tacos, we're going to be dealing with revenues and expenses, and that's the focus on chapter 3, the income statement.